Paul, our followers all the time, they want to know more about Berkshire Hathaway and why they've been slaying it for a number of years. They also are very interested, Mo, in Cathie Wood and her incredibly disruptive picks that go into her ARK investments. So I'd like to get your thoughts. This is the show. I bring normal people questions to you and Mo. Your thoughts about the difference between Berkshire Hathaway and his conservative value investing versus the enticing, amazing Cathie Wood.
She is amazing.
And her ETFs that are somehow not performing that well in an economy, in a market that's just completely exploding.
She's buying the dip, though.
They're basically, we're talking about two different sides of value investing. I'm sorry, not in value investing, of an investing mindset.
Oh, by the way, she criticizes value investing until she can make the case for her stocks being a value investment. As she said about Tesla, if you believe that Tesla is going to grow at 92% a year, it's a value play.
So give our new viewers just a 60-second, what is Berkshire Hathaway and what is their mindset versus Cathie Wood's, Paul?
So Warren Buffett is very big on, if I cannot project the company for the next 10 years and how they're going to make money and lose money and how much money they're going to make, I avoid it completely. Cathie Wood believes in disruption. What does she consider disruption? I don't think she really understands what she means when she says disruptor, because she has a long list of stocks here that are all disruptors, right? How can you have 25 disruptors in the stock market? Disruptors are literally like, I could probably name 10 disruptors in history, like real, truly genuine disruptors. You know what I mean?
Yeah.
Amazon's probably one of the most recent ones.
Yeah.
Apple. I look at this and think to myself, boy, she criticized Michael Burry recently, saying Michael Burry doesn't understand disruptors. Well, I don't think you do. And the reason being is she is investing in hopes and dreams. She's speculating on hopes and dreams.
Yes.
She's hoping that the companies she picks grow like crazy. And they very well could. A few of them could. But just like in the tech bubble, and just like the Nifty 50 of the 70s, eventually the things that everybody in public, we have our intern Nate, who's back at college, and he just wrote us a long text last night.
Yeah.
I was telling everybody about my job and the show and value, and they're like, well, Paul, Nate, it's not about value, it's about, the future and the community and all this stuff. And he was just like, man, these guys don't get it. I'm like, well, they're in college. Of course, I didn't get it when I was in college.
Me neither.
Right? None of us got it.
Yeah.
But Cathie Wood is basically running a fund that is going to jump on momentum. Yeah. She calls it disruptors. Listen, anybody can sit there and justify anything. When the tech bubble crashed, there were justifications for all valuations. When the real estate bubble crashed, there were justifications for all those valuations. But if those assumptions aren't accurate, and those assumptions don't realize that a lot more can happen to disrupt the company itself, then you're going to have problems. Warren Buffett just believes in buying companies that he can with reasonably guess and estimate how much money they're going to make over the next 10 years.
Yeah, guys. So let me slow you down. So in the end, let's take a look, Paul. I want to look at the companies that are in both of these holdings, both Berkshire and ARK, and really show you at home the tale of the tape between two vastly different ideologies of investing. About one that, you mentioned about Berkshire holding stocks for a long time. We are both watching some of the same old Warren Buffett speeches from the past where he talks about, I want to grab a company, and if literally the market completely shuts down for the next 5 years, I'm still happy with it.
Isn't that a great line? He says, if nobody tells me what's worth for 5 years, I'm happy getting that. That's the way I look at it for real estate. If nobody tells me, we bought those properties in Mexico 8 years ago. In the last 8 years, I literally have nobody ever telling me, what do you think here's how much your property is worth. But guess what? Every year, I make between 12 and 20% cash on that property paid off in cash. Do you think I care what I think what somebody thinks it's worth?
Yeah, you've never even...
I will collect that 12 to 20% a year for the next 60 years, and that house could be worth zero in 60 years, and guess what? I made my money.
So this really hits home when you start looking at some of the companies that are based on a lot of hopes and dreams for the future that are in ARK. So Paul, let's talk about what is inside the Berkshire holdings.
Okay, so this is going to be hard, and here's why. Berkshire has 80-some businesses that they own fully on top of their stock portfolio. We cannot put those businesses in here because we don't have all the financials for it, right, in our system. The other thing is he has a lot of banks in here. He has Bank of America. He's got American Express. He's got U.S. Bank. He's got other banks in here. So the 8-pillar analysis doesn't really work with banks very well,
Yeah.
but we can at least see a few metrics that are very important here. 1, 5-year PE less than 22.5. It's at 5.64.
Jeez.
5.64. Revenue growth, it's there. Net income growth, look at that net income growth. That's ginormous. Free cash flow growth,
Wow.
ginormous. Shares outstanding,
Down.
buying back 15% of shares. Okay, so these are a lot of debt, but the debt has to do with the banks. The banks have a lot of debt on them because of owing money to, et cetera. But shares outstanding down 15%. Now, let's go look at our friend at ARK.
So what Paul's showing you is the 8 pillars that we look before we invest in a stock. And with our software behind you, we'll go into this more, you can make an 8-pillar portfolio by adding a bunch of companies in and look at the companies as a whole. So keep going, Paul. This is ARK.
Now we're switching to ARK. We put the top 11 or 12 companies in there.
And look at this, folks.
Guys, this is terrible.
So what's their PE, Paul?
There's no PE. They don't make money as a whole.
money.
Their revenue growth is up. Obviously, they're disruptors. Their cash flow growth is up by $8 billion. Look at this. Shares outstanding.
Oof.
Up 214%. Guys, this means if you own a share, you own 1/3 of those shares, 1/3 of that portion of the company that you owned before. They diluted you by a factor of almost 70%. 70%, which means before, if you own one share and give you access to $10 in revenue, now you get access to $3 in revenue for that same share.
Yikes.
That is disruptive. It is disrupting your ability to retire.
So the companies that are inside of this is Tesla, Teladoc, Roku, Coinbase, Unity Software,
How is
Zoom,
Roku? Can we go back to this?
Shopify.
So
How is Roku disruptive?
I don't
Who here even
understand.
uses Roku?
I have 5 of them. I think they're
Oh, you
great.
do?
They're excellent. They are
Do
awesome.
you?
Oh, I like them
But-
too.
But they're not disruptive.
No.
Yeah, Apple TV
Apple
is great.
TV
I mean,
is like-
I think that Roku is far superior. I mean, I think that Roku is far superior to Apple TV.
Okay, I stand corrected then.
so she has Square, which of course there's so
We
many
love
different.
Square.
But there's different competition for Square.
And
Stripe,
that's the thing.
PayPal.
Did you say is Spotify in there?
Spotify-
Like, why is music streaming?
Yeah, Spotify
disruptive?
is in here. That's wild.
What's going
Yeah.
on?
Zillow is in here
It's
and
momentum,
DraftKings.
just like Paul said.
We didn't even get down to CRISPR. Some of these therapeutics, Paul. She's all over CRISPR therapeutics.
But and look
Beam
how much percentage of their
therapeutics.
portfolio they are, of the big ones down below. Robinhood, 0.86% of the 0.9% of the portfolio.
She loves Robinhood. Yep.
So, by the way, do I think Robinhood has a potential for being disruptive? Sure, because it's really getting a lot of young people. But I do believe that when this bull market ends, which it will end eventually, a lot of kids will stop trading on Robinhood because they will get hurt. They'll lose a lot of money, and they'll be like, I'm done with investing. It's the worst thing in the world. Now I would set them. So, guys.
So I bring this up, Paul, because we catch, if you as a viewer, if you finally found our page, which we have massively fewer subscribers than other people, because we're going down a lonelier road of investing like Berkshire Hathaway in boring companies, not these popular companies. But if you've been burned on these, Paul, this is the number one comment we get from people who finally find us is, I've been burned by these crappy stocks in the past year. I finally found you, and my eyes were open to how.
Why were their eyes open? Because it made sense. Guys, if it doesn't make sense to you, I understand. You're not at the right place. There might be some other way for you to make money, but I encourage you to figure out a way with some process like momentum or charts like Mo does. Don't just buy companies because they're cool companies that you like at any price whatsoever. That's what you're doing when you buy the ARK investments of the world, and they dilute the heck out of you.
Hey, Paul, what number of those remember we did the top 20 companies or something in their investment holdings?
17 lost money.
17 did not make money, guys.
17 were not
doesn't tell
making
you
money.
what
You
you
might
need to
sit there
know.
and say, well, yeah, that makes sense because they're going like, guys, these are companies that are tens of billions of dollars. They got to start making money at some point.
And just run through the companies and look, what does disruptive mean? I just ran through 3 companies. Why are they disruptive?
In Richer, Wiser, Happier, my favorite chapter was
Go on.
the very last one about Charlie Munger.
Yes.
And he said, you should work backwards.
Yep.
You should start from the end and say, what can I do to screw this up? So if you sit there and list the reasons, if I were to buy stocks, what would screw it up? Well, buy stocks where they're diluting me, buy stocks that aren't earning money, buy stocks where I'm paying too much for revenue and profit. These are the major metrics you look for if you want to look at the history of stocks, how you could F up buying stocks. This is how you F up buying stocks.
You're absolutely right, Paul. Charlie Munger says that one of the best pillars that he's gone through his entire life to be a great investor is just not do really stupid things.
Yeah.
And really stupid things are overpaying and buying things like that. I mean, guys, this alone, even if they were growing, this alone would get me scared. That metric alone would say, oh my God, they don't care about my ownership. They're not in line with me as an investor. All they care about is keeping their doors open. Right. You might sit there and say, well, it's good. Well, great. They finally keep their door open. If they have 10 years from now, 500% more shares, it didn't matter. If a company doubles its revenue and profit, but they also double the number of shares outstanding, you gained 0. Think about that.
I have to, Paul.
You have to what?
I have to think about it.
Think about that. If you buy a stock that's making $10 for your share, they double to 20, but then they double the number of shares outstanding, you only get access to half that 20 again. What do you get access to?
Back to your original.
10.
Yeah.
You didn't gain anything. The company can be disruptive, and if they dilute you, you're out. You don't make any money. In fact, you could lose money. That's what people don't realize about the silent killer of investing. This is the most silent killer of investing because nobody ever looks at the shares outstanding. This is disruption. This is the problem we have. So when they're losing money, how else? When a company is losing money, how do they pay for those losses? Issue debt or issue equity? Which one would a company rather do? Nobody ever looks at the number of shares outstanding, and that's what you're doing when you're issuing equity. You're issuing more shares, and you're diluting your current investors who trusted you with their money. Because if they issue debt, it makes the company look bad. And you as investors say, that's so much debt. Okay, great. What's the difference here? They're screwing you over here also. That is the problem. Their top 20 holdings, 17 lose money. Consistently lose money.
So that's our take on ARK versus Berkshire. It's funny is, Paul, you would argue there's only one way to invest. And in that book, Richer, Wiser, Happier,
I don't think there's only one way to invest.
The term value investing is synonymous with investing. And
Correct.
This is obviously the opposite of value
This
investing.
is absolutely the opposite of value investing. So guys, there are 2 ways to sign up for our software. One is through Patreon. We love Patreon. If you love Patreon, go to patreon.com/everythingmoney, join any one of our tiers, and you can sign up very easily. If you want to go to everythingmoney.com and sign up, you can as well. The benefits of that is, 1, you don't have to pay sales tax yet. It'll be deferred for quite a while because we're not big enough. And 2, unfortunately, Patreon system now double charges at the end of the month. We don't do the double charge. So if you sign up on the 15th, you're charged on the 15th of every month. With Patreon, you sign up on the 15th, you're charged the 15th and the 1st of next month automatically. And then from there on out, you're charged. So it's whatever you want to do. We love both systems. They're both great. They work great for both of us. We have thousands of people on both of them.
Yes.
You choose what works best for you.
That is our take on Berkshire. My son loved Berkshire B. Paul, he bought some of this and has
Did he?
He just said I had to have some Berkshire. His main goal in life is to own 1 share of Berkshire A, which is $400,000.
I love that your son is 11 years old. His goal, my goal at 11 wasn't even to own a Berkshire Hathaway share.
He loves it, and so he owns a couple shares. He's very proud.
What was Berkshire at when I was 11?
Oh, can you imagine?
Well, I remember when I was 16 or 17, it was 37,000.
Berkshire A?
Yes. So let's see. Berkshire A. Let's go to the chart.
Very nice, Paul.
Max.
When were you 11? This is
Right here,
1990.
1992. $8,800 a share.
88? Wow, it's $400,000.
Oh my God, it's $425 now? Jeez, oh Pete.
It's incredible.
So right here, June, July. Yeah, it was basically $9,000 a share.
Dang.
It's up 50 times or whatever, almost 50 times, 45 times.
Don't you think at some point in your life you want to get 1 share at this, Paul? Just for
I've had multiple shares of this company.
That's awesome.
Yeah, and I sold it though because I wanted to be more active with my own investing.
Yeah.
And as Berkshire gets bigger and bigger, it's gonna be harder for them to beat the market. And it makes perfect sense. The bigger and bigger a fund is, the harder it is to beat the market. Don't expect to buy Berkshire to beat the market. Buy Berkshire because you want solid companies that will do well and probably not do poorly over that. And then when markets fall, Berkshire will fall. As Charlie Munger said in Richer, Wiser, Happier, Berkshire stock has fallen in half 3 times since they've owned it. 3 times it's fallen in half. Use that as an opportunity to go buy more shares.
That's our take. Tickle a thumbs up on the way out and join everythingmoney.com or Patreon to get the software. Love you guys. See you.